But like I was telling you, I'm more of a Robin than I am a Batman. But it's nice that people think that I'm Batman, Carl.
No, they can see it with the little figurine, right?
Yeah, that's as good as they're gonna get here. But hey, let's get into this weekly sense episode. So obviously we can't talk about what's going on over the last week without talking about inflation numbers that we got. So inflation CPI index came in at 6.8%. That's basically 7%, which is the highest it's been in 39 years. So obviously inflation's running hot. I know the Fed chairman came out and basically said we were wrong with the transitory terminology. I think about 75% of CNBC commentators were also using that. Now they're not, which is a completely different topic. But so inflation's running hot. I think it's a lot higher than that. You and I talked about that this morning, where in my opinion, that CPI could be as high as 8 to 10% if they actually calculated some of the true numbers like rents versus just surveying people. So where does that leave us right now, Carl? I mean, it's a pretty big number. Clearly, right now, with the federal fund rate at emergency levels of 0, the Fed seems to be a little bit behind the curve. Do you have thoughts?
Right. So they're being pushed to move a little bit faster. But yeah, inflation could go on a little bit longer because it's going to take some time for the rent increases and housing cost increases to really filter through. That's an ongoing thing that's been going on for the last year, and it
Right.
continues to go on. So, but there are still a lot of idiosyncratic things going on out there related to consumer behavior and supply chain disruption. So while there's more pressure on them to taper bond purchases and get to hiking interest rates, I don't know that it's going to be a fix immediately. The economy is going to have to get more back to normal. But
yeah, I mean, how much will 25 or 50 basis points really slow down the consumer? Because we're already at these emergency levels, right? So if we got a couple rate hikes in that put us at 50 basis points as an example, is that even enough to stifle the growth a little bit and decelerate growth to tame inflation? And I don't know. And I think the interesting problem that the Fed's in right now is that they're really combating or fighting or going up against two forms of inflation, or what I would say twin inflation, which is not only CPI, but also asset prices. They're between a rock and a hard place of raising interest rates too fast and, potentially popping a number of asset bubbles that are out there, whether that's in cryptocurrencies, whether that's in high growth stocks, which we'll talk about here in just a second, whether that's in home prices that we've seen, accelerations of like 20% plus year over year. So they're really going to be in this spot where they have to combat both of those sides of the sword.
Right. And the surprising thing about it all to many people is that treasury yields haven't moved up. In fact, the longer term treasury yields have moved down. And I think that's great evidence that the inflation that we're seeing is more damaging than it is evidence of economic strength. And they won't be able to get as many rate hikes in this time. And this business cycle is going to be shorter, like we've been saying for a while. So that's why this week, the Fed meeting is going to be very important, and what the language is in terms of confirming how fast the tapering of bond purchases will happen. I mean, we're thinking maybe sometime like March, but how many rate hikes that they will get to implementing next year?
And that's what this shows right here, right?
Yeah, this table right here is Fed funds futures and target rate probabilities, as of the end or mid-December next year.
So a year from now, this is basically looking at the probabilities of where they think the federal funds rate's going to be. So that first column would be, 1, 2, 3 hikes, 4 hikes, 5 hikes, right? And so on and so forth. Or 0, 1, 2, 3, 4, 5.
Right, because we're at 0 to 25 right now. So there's a 14% chance of one hike getting you to the 25 to 50 basis point range, 27, almost 28% chance of another one, and 29% of 3, but there's still 18% chance of 4 rate hikes.
I think that would devastate the market.
Chance of 5. So what's important about this is that this chart almost never looks like this, where there's this much uncertainty around how many rate hikes there will be. I think it just makes things ripe for volatility if there are any surprises, and you're ripe for surprises because there's a wide range of what could happen next year.
And Carl, explain to everybody why it's important. Why do people care what the Fed does with the FFR? Like, how does that impact things?
Well, it affects what it costs to borrow money. So the Fed funds rate is the rate that banks charge each other with money that's held by the Federal Reserve on overnight loans. And so it affects what they're able to borrow money at. And it also affects the rate of, since short-term deposits are competitive with that, it affects those rates too. So the rates that you would get on short-term treasuries or cash in an account at a bank.
Right.
And ultimately, the reason.
But I think, and more importantly than that, it affects asset prices, specifically on publicly traded equities, because how we try to price things in is by using discounted cash flow models, right? When we're taking a company's future earnings and discounting it back. Well, if we're discounting it back at basically a 0% federal funds rate, and all of a sudden that jumps to 1% next year, which according to what we just saw, there's an 18% probability of that happening. I mean, that's going to cut a lot of those high flying stocks a tremendous amount, right?
Right. Well, that's why there have been people who have been saying no price is too high on some of those really high growth stocks this year and last year. And now that seems to be coming to an end because there's money is going to have a time value again. Well, it does at the long-term end, just not at the short-term end. But the bigger thing about why people care about rate hikes is that it affects the shape of the yield curve. And as you get to have a more flat yield curve, the profitability on new loans for banks goes down, and they don't make as many loans. And
so let's explain that.
Maybe they stop. And so that slows the economy down.
Right. So let's explain that really quickly. So if the yield curve's flat, that means that the cost that banks get money from the Fed is almost equal or equivalent, and sometimes inverted, but equivalent to what they're lending it out on. So they borrow from the Fed at basically a 0 year, and they lend it out at a 15 or 30 year. And if there's not a large enough spread between those two, it's not profitable, or it's extremely low profit for those banking institutions to make those loans. So what do? They start to tighten their belts, right?
Right. There's not enough profit in it to be worth the credit risk.
Whether it's money
from the Fed or another bank, or a depositor, like you go and open a savings account, and that's how a bank works. They lend long-term, for people's mortgages or car loans or other things, and they borrow short-term from depositors who put money in, or if they get it from somewhere else, like the Fed.
Right. Yeah, that's interesting. You said that, and just to kind of transition. So, I mean, that's why it's important for the markets. It's important because that base rate is essentially a part of the calculation to project out what future company earnings are going to look like and what the price is to pay on those things. And what we saw over the last, let's say, 18 months is an extreme amount of frothiness around these big ideas. And I think you can really only correlate it to, the .com bubble of pets.com, toys.com, or the number of companies that were riding the wave of the internet and coming to market at these extreme valuations, looking out to prospectuses that were, projecting initial revenue or maybe even profit 7, 10, 15 years out. But because the idea was great, and because of all of this easy money and all the money that people have made over the last 7 to 10 years, whether that's in the tech space, in the crypto space, or a number of other areas, all this money is continuously flowing through the system. So what I wanted to bring up was basically a chart of SPAC performance.
Right. And so it was a different acronym this time, not IPOs, but
SPAC. Yeah. So, which is a special purpose acquisition company. So essentially, if Carl was running a SPAC, what would happen is he would raise money from a large number of investors. And from there, he would have a certain amount of time to go out and find a company to take public. So what we've said, and we said this on previous episodes, is that, you know, the unfortunate thing is that a lot of these companies probably should have stayed private, and they didn't. And here's basically a list of SPAC performances from their 52-week highs to where they are now. You can see this first one that topped the list, symbol HYMC, is down 91%. But it's, I mean, that's not just an outlier, Carl. You go down all the way down this list. It's either Clover Health, which is the future of health medicine, quantum space, single state battery cell technology. You come down a little bit further and you looked at, you know, Virgin Galactic, which is down 75% from its 52-week high, or Him and Hers, which is the healthcare company, at-home delivery healthcare, or something like a Joby, right? And we've had clients over the last 12 months chasing these returns of these companies because it was a cool thing to do. It was a meme stock, betting on the future, holding for the future. Well, the higher price that you pay today, the lower potential future returns that you have. And that has to be drilled into the mind of investors when they're looking at these things, or you're going to get caught flat-footed holding the bag. So as an example, Joby, they're supposed to be the air taxi future of Uber. So where everyone's going to be flying these air taxis around for transportation. However, they went public at a $50 billion valuation, and they don't expect to even make any revenue until 2025. So when Carl and I talk about the fact that, you know, if interest rates rise, it cuts all of those projections. And you can see here, it's down like 60 or 70% since its 52-week high. I mean, but this list goes on and on and on. And clearly this bubble definitely burst. But you and I were talking that what's interesting is that it hasn't bursted the entire market yet, like the dot-com bubble did, the NASDAQ did to the other indexes. And you said something interesting on that. Do you want to repeat it?
Oh, well, I mean, one
There's
thing,
different legs.
well, one thing I was thinking about this was that eager investment dollars are met even more eagerly with, you know, supplied investments for those dollars.
Yeah. Or art
But
pieces,
why,
right? Yeah.
but why is the market still holding up pretty well? Well, people want exposure and people are still putting money into index funds. And companies like Apple, even though it's one of the slowest growing companies in our portfolio, has done really well because people view it as defensive tech. They view it as
Right.
a proven quantity.
Yeah, wait to if you see big tech, Amazon, Microsoft, Google, Facebook, Apple, maybe even Netflix, it's close up there, Tesla even now because of the size. And when you see those names really starting to roll over 7, 10, 15%, the market's, there's not enough breadth in the market right now. It's eliminated.
Right. Well, we probably won't see that until we've had plenty of rate hikes.
Right.
I mean, there could be a correction sometime before then, but you probably wouldn't see a big rollover in the big names until you're up against the rate hike limit.
Yeah. Well, I'd be interested to know what the returns to the S&P 500 are this year. Maybe we'll do this next time. X energy and financials. I bet it'd be in the low double digits.
Right, because energy and financials have been big outperformers this year.
Huge outperformers. So that's interesting. Okay. So SPAC bubble burst. We went over inflation and the options the Fed has, whether they're going to accelerate the time frame on the first rate hike. So I just wanted to kind of, close it out. You're getting ready to, get a suntan on vacation, which is nice. And I'm jealous, depending on how warm it is down there. But
there was one noteworthy thing that we wanted to mention as well that, is kind of another rare, characteristic of the environment, and that's CEOs and insiders selling record amounts of their shares. So first it was Elon Musk, and then it was Satya Nadella over at Microsoft selling half of his holdings. And the list kind of goes on and on,
Jeff Bezos, Elon Musk, the CEO of Microsoft, Yeah, well, Chamath Palihapitiya said this. He said, the only thing you have to know is that the smartest two people in the world are selling their stock. It's like, that's the only thing you need to know. Now, how much validity is in that? I'm not sure, but it is something interesting to point out when you see some of the largest CEOs in the world for the first time in a long time. Now,
Right.
I
It
think
doesn't
Elon,
happen. It doesn't happen very often.
at least not to this scale, right? Where I think it was 60, yeah, like you said, 69 billion, which is the most in history. Now, asset prices are the highest they've ever been, so that would correlate, with the most in history typically. But yeah, it's something really interesting to watch out and be aware. Is it a leading indicator, Carl?
I don't know, but it reminds me of all those people on Shark Tank that got rich in the dot-com bubble.
Like Mark Cuban,
Hmm.
he timed that pretty well.
Yeah, and even the lady that was in a 60 Minutes segment yesterday on their inn they built in Newfoundland, like she was a CFO of JDS Uniphase in
Oh
the late
wow,
90s.
perfect timing, I would assume.
Yeah, right.
Right.
So yeah, I mean, so lots of heavy insider selling is not it's not a good sign. It's a cautionary thing, and it's something we have a close eye on.
So looking into 2022, what are going to be some of the major themes that really control asset prices moving forward?
Well, the big things are what happens with inflation. Does it keep going strong, or does it weaken? And what's the pace of rate hikes? And is there an announcement there that surprises people? Like
Yeah,
those are really probably the biggest things.
yeah. In addition to that, I think the Biden administration's really been placed in a tough spot. They got elected at least partially on the idea of large government stimulus and accommodative programming. And when you get a large print of 6.8% on the CPI, and the only comments that are made from the White House is the possibility of a bill being introduced to cut the work week to 4 days a week, it's like they're walking around with blinders, right? So where they're in a tough position is that they've promised all of these programs, but the programs that they're wanting to get accomplished are this $5 trillion Build Back Better plan, which the CBOE said that over 10 years it's going to cost like $3 trillion under the deficit. It's just going to add more tinder to that inflation fire. So I think policy is going to be a big thing going into fiscal support, and seeing what that's going to be like in 2022, and seeing if they can get some of these big, large bills passed.
Right. Well, I mean, the big lesson from it is that throwing extra money around doesn't solve supply imbalances or undersupply, or
Right.
long-term structural undersupply kinds of issues. And we're seeing that in energy a little bit. You have to have policy to directly address those things. If you
Right.
just throw money around and stimulate, what you end up doing is you end up just pushing prices up. And I
Right.
think that was the lesson of all the healthcare reform policies from 10 years ago under the Obama administration.
Sure.
It sounded great, but really what it ended up doing was just, yeah, more people in it being covered, but it increased the cost of everything, when really they should have been more focused on increasing the supply, but it takes a long time to do that. That's not something you can do quickly.
Yeah, especially in that space. But,
Well, other
okay.
spaces too. I mean, energy and a lot of things are like that. You can't just
Yeah, I do want
fix
to.
it overnight.
Thanks for saying that. I do want to just point out before we sign off that there are, this inflationary number was for the month of November. So, and it was just really been over the last, 30 days or so, where we've started to see some of these high prices on some of these commodity prices that actually do affect inflationary numbers starting to really come down. So I wrote them down. Lumber's down 33% from its peak. Oil's down about 15. It was down about 20 up until last week. Natural gas, which is a big surprise, that's down 38% just in the last few weeks off the potential news for a warmer winter. And then the cost of shipping has actually started to come down. So, maybe the Fed, hopefully the Fed is right, where it's maybe not going to be that out of control and it will work itself out. But I'd probably bet on the opposite end of that coin, where they're going to have to take some Fed action, and it's going to put prices, it's going to put some pressure on some of the higher valuation areas of the market.
Well, the scary thing is that they have to figure out what to do, and we won't really know for sure if it's right or what will happen. And
Right.
we'll get more clarity probably by the middle of next year.
Yeah, because it's one, they have to finish tapering. And then, even if they hike at 25 basis points, I mean, that's, like I said earlier, like even if the federal funds rate was at 50 basis points, I don't think that that's enough to really throw things out of whack. And, hopefully I'm right on that.
Right. Well, we'll have to keep a watchful eye and see where things go. But
Yeah.
I would be pretty confident that we're not going to have as many rate hikes as people thought even a few months ago. And we may even get yield curve flattening, like in the, who knows, the 1.25% to 1.5% range.
Well,
As
hey,
scary as that might sound.
Look, if you have an extra crystal ball, can you put that on my Christmas list this year?
All right, I'll have my eye out. I'll be watching and shopping.
All right, Carl. Hey, everybody, we're going to sign off. I think this is going to be the last one for the year. So next time we see everybody, it'll be next year, 2022. Looking forward to a prosperous year. And thanks, Carl. I really appreciate your time.
All right. Happy holidays and New Year's resolutions.
Yeah, amen. All right, bye.
Bye.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.